All right, guys, here we go. Chapter 10, Part 4. The Patient Protection and Affordable Care Act, otherwise known as Obamacare. Now, this was designed so that every single person in the United States of America would have health insurance. That was the end goal. And the essential benefits of the PPACA, there's a list of them in your book, and there are, looks like, 10 of them. So ambulatory patient services, emergency services, hospitalization, maternity and newborn, mental health and substance abuse, subscription drugs, rehab services and devices, lab services, preventive and wellness services, pediatric services. So those are the essential benefits, and those are the things that must be offered in an insurance plan in order for it to be acceptable to the PPACA. And so there are some things in there you're like, well, I don't use that, but we've got to remember these are group employer health insurance plans. So not everybody has children, not everybody's going to have children, but those are still considered essential benefits. So what is the employer mandate or the shared responsibility provision? So this law went into effect in 2010. Some of the things that we're going to talk about today have changed quite a bit over the past 10 years. So the employer mandate, though, still exists. And what that is saying is that as an employer, if you have more than 50 employees, if you have more than 50 full-time equivalent employees, then if you choose not to offer health insurance with these minimal essential benefits to at least 95% of your employees, and as we'll talk about in a minute, one of your employees actually goes out and purchases health insurance on the exchange, which again I'll talk about in a minute, then the employer has to pay a penalty per employee. All right. So let's go to the next one. What is that? FTE is the full-time equivalent. And then you wouldn't think that that would be so difficult to calculate. But remember, you've got some kind of part-time employees, some full-time employees. How many hours are there in there? Because for this law, 30 hours is considered full-time. Whereas you guys already know, the Fair Labor Standards Act, it's 40 hours. So you might want to just kind of go on to this website, give it a check, because it's, again, interesting. Individual mandate. What that was saying that you young and healthy people, everybody needs to have health insurance. Health insurance can be expensive, especially if you're not employed or if your job doesn't pay that much and you've got student loans, and if your employer doesn't offer a health insurance, so you would have to pay a penalty. So that actually went to the Supreme Court because people felt like that was a taxation on individuals, and they disagreed with that. So the Supreme Court said it was legal for the federal government to apply this individual mandate or tax. But when the Republicans came into power, they knew they couldn't do away with the individual mandate, but now it is set for $0. So in effect, it no longer exists. The Cadillac tax that your book talks about says that if that plane was too rich, the employer-sponsored health care plan was too rich, then that employer would have to pay a penalty. Well, it never really made sense to anybody, and it kept being pushed back and pushed back and pushed back until now it's been fully repealed in December of 2019. So again, this has been the law for 10 years, but the Supreme Court has decided that they are going to rule on the Affordable Care Act's validity. Is it constitutional in whole or in part? And that's going to start this October, and they're expected to have a ruling by next June 20, 2021. So this is the employer mandate. Okay, these are the two different pieces of the employer mandate. So the first one that you see here is that the employer must offer those minimum essential coverage to 95% of its full-time employees for the entire calendar year, and full-time employee obtains a premium tax credit for coverage purchased on an Affordable Care Act exchange. So if you fail to provide the minimum essential coverage and somebody goes out and purchases their own health insurance on that exchange, and anybody can do that. Every state has an exchange. Some of them are state run, some of them are federally run, but you can go out and you can buy your own health insurance on that exchange. Okay, so that's two things. Now the third thing that has to happen is the person that purchases that health insurance on the exchange receives a tax credit. Okay, so people with it varies based on what your earnings are, and then the federal government may subsidize your health insurance because, again, they want everybody to have health insurance. So they're trying to make it affordable. Well, if the federal government is paying money for somebody to get health insurance, that they feel like the employer should be providing that health insurance, then they're going to put a penalty on that employer. Okay, so that's the first part. Then there's another one that says if the applicable large employer doesn't offer, or does offer coverage to at least 95% of its employees, but that employee doesn't see it as affordable because the coverage is not affordable, when they define affordable as 9.78% of household income. And again, now that person goes out onto the exchange, they purchase their health insurance, they get a tax credit, then again, there's a penalty assessed to the employer. Now what you also see here is underlines, minus the first 30 employees. So let's go to some examples so that you can see how that's calculated. So there's an employer with 150 full-time employees. He doesn't offer health insurance to its full-time employees. At least one full-time employee buys tax-subsidized health insurance through the marketplace exchange and gets that premium tax subsidy, right? So that's that tax-subsidized health insurance. So then the employer's penalty this year would be 150 employees minus the first 30 employees times the penalty per employee, which is at $2,570. So the total penalty for that employer would be $308,400. Now, depending on how much the insurance is, that may be worth it to this particular employer. They may work out a different agreement with their employees and help them purchase health insurance on the exchange or in some other ways that we'll talk about in a second. So that's called play or pay. All right, you're either going to play by the rules or you're going to pay the penalty. All right, so now let's take a look. Let's say it's the same employer with 150 employees, but instead of it being that it didn't meet the minimum standards or the essential benefits, that it was not affordable. And so in this case, employer had 10 of their employees go out, purchase their insurance on the exchange, and receive that premium tax credit for 6 months. So here the IRS penalty would be those 10 employees times the 6 months, 6 months out of the 12, times 3,860. So in this particular case, for that, for it not being affordable for these employees, and they went out and got the premium tax credit, here it was 19,300. All right. Now, comp in the news. So how much are people paying as a percentage of their income? More of that shift. So health insurance premiums have been going up, and employers are trying to figure out what they're going to do with that. So they had shifted more of the cost to employees. I think that's kind of leveling out now, but even here you can see that in Mississippi, people can spend more than 16% of their incomes on health insurance premiums and meeting the deductibles. So, and that compares to the average cost burden of 8.4% for those in Massachusetts. And part of that is not that the health insurance is so much more. Here it is that our income, so it's a percentage of income. So Mississippi has the second lowest median income in the country, as you can see, compared to Massachusetts, which is among the highest. Now, what I want you to do, if you would, is go out to the healthcare exchange. And I want you to see, is it really affordable, right? So again, imagine your first job, now you're making $40,000, you're young, you're healthy, and see how much it would cost per month for you to purchase your own health insurance on the exchange if your employer didn't have that health insurance. Just figure out, is it affordable for you or not? And the question here is it better for low-income employees to have insurance through employer or let them use the exchanges? So for low-income employees, you guys went out and looked in part 3 of chapter 10, the question was, how much are people paying for their premiums? And it's probably around $500 a month. That's a big chunk of change for somebody who's not making that much money. It might be better for those employees to actually go out onto the exchange and get that tax subsidy, so that would reduce their amount that they're having to pay in premiums, maybe even to nothing. All right. So again, that's just a choice and things that different companies are having to look at. So more companies are also going with both traditional and high deductible plans. So a traditional fee-for-service plan or a PPO, and then you have a high deductible plan. It's about options. You've got all kinds of employees, they're wanting to do different things. So there's the higher premiums and deductibles, those things will be for the traditional plan, and then a high deductible plan. Again, if you are young and healthy and you don't get sick very often, then you might just really need catastrophic coverage. So have that high deductible plan. The premiums will be less, so you're paying less out of pocket unless something should happen to you and you really need that care. And in that case, you do have insurance. It's just that your deductible is a lot more. All right, so that's that for now, and then we'll finish up in the next section.